love what you home in on in the piece, which is about the art of subtracting from your portfolios more than adding to them. I mean, I just want to ask you about that firsthand before we get into, because I feel like I know what you're going to say about GameStop and Dogecoin. I don't think those are going to be Jason Zweig endorsed investments, but I want to know what would be. And it's interesting to me that Charlie Munger, Jason, is all over TikTok. And I love it because here's a guy who sits there and says, you can own 3 stocks, you can own 1. And that might be a better way to go than owning the S&P 500, but he would probably be the first to say you do have to do your homework in that case.
Yeah, I mean, I think it's really important for investors to separate investing from trading, from speculating, from gambling, Kelly. And look, there's nothing wrong with gambling or speculating as long as you know that's what you're doing and as long as you put boundaries around it. I mean, you don't want to let it contaminate everything you own and all your strategies. But if you're the kind of person who used to enjoy going to Vegas for the weekend or buying a lottery ticket, there's nothing terribly wrong with doing that in your portfolio as long as you segregate it and keep it from infecting the rest of your thinking.
You know, I've heard that some great traders, for instance, professional traders, big time, you know, what would now be money managers, but they will do things like when they enter a trade, write down when they're going to exit it. Because once you're in it, you change your mind all the time. You change based on new information, and sort of to keep yourself honest, you say, no, going into it, I said, if it's up 30% or if it triples or whatever that is, that's when I exit. And exiting can sometimes be the hardest part.
Yeah, it's very difficult, especially at times like this and for individual investors when emotion can really sweep you up. And, you know, you see online and through social media so many people boasting about their getting rich quick. And in the old days, you used to have to go to a barbecue or the dentist's office or whatever it might be to hear that kind of thing. But now you're exposed to it nonstop. So it's very important to set those boundaries before you make the trade so that you can remember why you're in it in the first place and have a plan for when you're going to get out.
So, Jason, let's say I'm somebody who owns Bitcoin and I'm trying to figure out when to exit it. What would you say? And I'm sure your answer would say, well, it partly depends. How big is it in your portfolio and so forth. But, you know, I guess I picked that one because stocks you can at least analyze with cash flows and project. But something like that, I mean, is the answer everybody thinks they're going to know when to exit. But if they knew that, then they would never be the one sitting there holding the bag going, I should have sold back when it was at fill in the blank.
Well, I think probably for most people, the easiest approach with something like Bitcoin is to set a target percentage of your overall portfolio you're willing to commit to it or risk on it, depending on your point of view. There's lots of people out there who think it's going to 200,000 or 1 million or the moon, and that's fine. But if it ends up being 100% of your portfolio or 50% for most people, or even 20 or 30 for many, I think that's where you might want to draw a line in the sand, and you should do that ahead of time. Because once you get near that zone, you will revise your expectations. And you will find it very difficult to let go unless you pre-committed to a target.
Shepard Smith here. Thanks for watching CNBC on YouTube.